Welcome to the new era of video creation with AI stock picking Apple to hit $3 trillion market value. Here are the contents. Apple is the most valuable publicly traded company in the world, and that didn't happen by chance. Its strength lies in a powerful ecosystem: iPhones, Macs, AirPods, Apple Watches, supported by a sticky and growing services business. Whether it's iCloud subscriptions, App Store purchases, or Apple Music, the company monetizes customers repeatedly through high-margin channels. Add in Apple's enormous cash pile, share buybacks, and consistent profitability, and you have one of the most stable companies on the planet. That said, Apple is no longer the high-growth story it once was. Revenue growth has slowed, and its innovation curve, while steady, isn't as headline-grabbing as generative AI or cloud infrastructure plays. As such, while the company remains a great core holding, the price you pay matters more than ever. Buying at peak valuations during periods of exuberance could limit upside, especially if earnings merely meet expectations. This presentation will help identify a more strategic buy range for long-term investors. We'll look at valuation metrics, technical support zones, and reasons why being patient, even for a company like Apple, can lead to significantly better results. Apple is currently trading around $195, close to its all-time highs. The recent surge was driven by new AI-powered iPhones, improved Mac sales, and bullish forecasts for its services business. But despite the excitement, revenue growth has been relatively flat, and that makes the stock's valuation look stretched. It's trading at a forward price-to-earnings ratio of about 30, which is significantly above its long-term average of 22-25. That kind of valuation implies strong, accelerating growth. But right now, we're not seeing that in the numbers. The concern here is that Apple might be benefiting more from market momentum than from real earnings expansion. That's not to say Apple isn't a great company. It absolutely is. But when a stock trades at elevated multiples without strong growth to back it up, downside risk increases. Any disappointment in iPhone upgrades, service growth, or macroeconomic pressure could send shares 10 to 15% lower. And that might not be a bad thing. It could actually present a better opportunity to enter or add. In the next slide, we'll look at what range might represent a more reasonable, risk-adjusted buy zone. Based on valuation history and recent technical patterns, the most strategic range to buy Apple would be between $160 and $175. At that level, the forward PE compresses to about 23 to 25x, which is much more in line with Apple's decade-long average and better reflects its current growth trajectory. This zone also lines up with major technical support from previous consolidations, making it a natural place for institutional investors to step in during corrections. While Apple will always command a premium due to its brand power and financial strength, paying above 30x earnings when growth is flat doesn't offer a great margin of safety. Waiting for a dip into this lower band allows investors to buy into Apple's quality without overpaying for it. It's also a better risk-reward setup. The downside from this zone is likely smaller, while the upside return potential improves significantly if the company surprises with innovation or services expansion. Remember, the goal isn't to time the absolute bottom, but to enter when valuation aligns with fundamentals. If AAPL does retreat to $165, it may feel counterintuitive to buy amid weakness. But that's often when the best returns are made. Apple isn't immune to market cycles, and in some ways, it may be more sensitive than ever. With a market cap above $3.4 trillion, it takes huge earnings beats or product successes to justify further price expansion. While AI integration may help, especially if Siri gets a major upgrade, investors may be ahead of the reality. Hype has pushed valuations higher, but if results don't blow past expectations, the stock could be re-rated downward. Apple also has exposure to macro risks. Slower iPhone demand in China, regulatory pressure on its App Store, and inflation weighing on global consumer spending all present downside risks. With a PE of 30, there's little cushion if any of these concerns worsen. In contrast, a dip of 10 to 15% would bring APL closer to its value comfort zone, a far more attractive point for patient investors. Successful investing isn't about chasing what's hot. It's about knowing what something is worth and waiting until it trades near or below that value. With Apple, that means waiting until the valuation reflects the reality, not the narrative. In summary, Apple is undoubtedly a crown jewel in global markets. Its business is built to last, and it remains a top pick for stability, cash flow, and innovation. However, the price you pay determines your return. And right now, the market is pricing Apple as if growth will accelerate sharply. That may happen, but if it doesn't, today's high valuation could weigh down future returns. By waiting for a dip into the 160, thus a $175 zone, investors can align with Apple's historical valuation norms and set themselves up for stronger, safer long-term compounding. This is especially relevant if your holding period is 1 year or more, because a slightly better entry point can mean thousands of dollars more over time. Ultimately, investing is about balancing quality with price. Apple is a quality company. But even the best merchandise should be bought at a fair price, not a retail premium. Don't just ask, is it a great company? Ask, am I getting a great deal? With Apple, the answer might be yes, just not quite yet.